Hello everyone, welcome to another episode of Capital and Context. I am driving solo today, no Mark with me. I am Sam Howlett, Chief Investment Officer of Cape Berkshire Asset Management, which is the trading name of Ascot Wealth Management Limited. We are, as an FCA regulated and authorised firm, obviously everything we give here is for informational purposes and not advice or personal recommendation. We're very keen to illustrate that. However, it gives a bit of insights of what's going on within the industry to you, our listeners. So segueing into that, the last week, currency markets have given us something that we've rarely seen. So whilst the yen often has an intervention, well, I say often, not uncommonly, an intervention by the Bank of Japan to help support it. The yen has been selling off quite a bit over the last few years. Something quite rare happened, which was a coordinated US and Japan intervention to prop up the yen. And it's that coordination that's a little bit rarer. Last time this happened was in the wake of a 2011 tsunami, unintentional pun there on the wake part. The scale was a record 8.5 nearly trillion yen in one day, with another 5 1/3 the next day. So the government buying its own currency by tens of billions of dollars. And it works in a moment. And I think we'll touch on that a little bit later. The yen was at a 40-year low, around about 163 yen to the dollar. Snapped back as much as about 5% over the next 3 sessions. This is a real move, and it has real implications for the wider market, which again I'll talk about a little bit later. There's a little bit of a political angle with this, which is the US president, Trump framed it as, friendship, a little bit of help. He said that, our good friends in Japan, good trading partners, kind of. And that's interesting because of what the US sold to help prop up the yen. So rather unusually, normally in these circumstances, it's a case of sell dollar, buy yen. What the US did in this instance was it sold euro and bought yen. And I think that's kind of a little bit interesting. Again, we'll talk about that a little bit more. It's not just bilateral. Apparently, not North Korea. That'd be interesting. South Korea was active in this as well. So it was a bit of a regional effort to steady Asian currencies versus the dollar. The thing that could be a bit worrying here is this a bit of an early warning about the plumbing of this global system? This feeds back to what myself and Mark covered over the last couple of weeks, and also how far our authorities will need to go to defend this. So this might be a template that other geographies lean on to support their currencies or etc. But I think the real 2 questions here is, why is the yen so weak, and can it actually be fixed in this manner? So there isn't really anything Japan has done wrong for the yen to get this weak. It's largely due to the US-Japan interest rate gap. So as you know, the Fed has stopped hiking this year to a range of 3.5 to 3.75%. The Bank of Japan, don't get me wrong, has been raising, but to just 1% policy rate, which in itself is the highest since 1995, but he's still got a good 2.5-2.75% difference there. So there's been something that's been going on for quite a while now called the carry trade. So what ends up happening there is you borrow cheap yen. Borrowing markets is kind of a little bit of a way of, you're selling what you don't have. But you have to, in case of borrowing that, normally you pay the policy rate, so in this case 1%. You then park what you've borrowed into a higher yielding currency, dollars, at 3.75%. So you're pocketing 2.5% difference there. And you then later sell the yen. So, that gap has been this relentless downward pull on the yen. So it's a rational reason. It's not speculation, but it means there's been a long time ongoing element there. There's also an energy dimension to this. So Japan imports all of its energy practically. So during the course of the Iran war, obviously as oil's been going back up, oil trades in dollars. So Japan's been having to buy more and more dollars to pay for this energy, which meant more yen selling, which, created a weaker yen, which makes imports dearer, which created this vicious loop of, driving up cost of living, but which is obviously politically intolerable. And when inflation goes up, normally, of course, you would be, you find the government interest yields go up, to counteract this, so that the real yields stay fairly similar. Although the Bank of Japan has ended the formal yield curve control policies it's had in the past, it's still buying huge amount of Japanese government bonds. What that means is that the yields are held artificially low, and then that means that you look at the yen and it's still looking overvalued on some metrics. So one big bank is still forecasting a 12-month forecast up to 165 yen to the dollar, even after the latest issues of the government intervention, back down to 155. Now that it kind of feeds into what we were going to talk about in terms of, is this actually a way to fix this? You find that most of these currency interventions, they work in short periods, but actually fundamentally, ironically, the fundamentals are still going to drive this for a longer period of time. And the reason why they've been intervening in this way is because the one thing it's not wanted to do is not to fund this through a sale of US treasuries. If you sell US treasuries, obviously the yields on those treasuries go up. You're kind of enhancing the carry trade. So I think that's why they sold euro, is because it's not awfully, in terms of developed markets, it's probably the closest one in terms of policy rate to the yen. To the Bank of Japan's 1%. So it's kind of like the most policy neutral way to do it. But the thing is, though, despite the huge reserves of central banks, etc., they're not infinite. So every operation that they do, spends down these reserves, and the market is sometimes going to test the resolve of this. So I'm not sure that they could do this for an incredibly long period of time, but it does give a short-term signal that, look, wouldn't bet against the yen beyond the low 160s for too much longer, especially if the if the US Treasury is going to be involved in this. So why now is the US started doing this? It very rarely does this. As I said, on the surface it's a friendship. The real answer is, there's a self-interest and plumbing of the global bond market here, which feeds into what I said about with if the yields spike up on Japanese bonds, it then makes US treasuries start to appear not as attractive to Japanese bonds, and that's important because there are an awful lot of US treasuries are held by Japanese entities. So there might be a repatriation of capital from the US to Japan, which means that then US treasury bond yields go up, which feed through across the world in that instance. An awful lot of, UK government bond yields going up is actually a function of what's already happened in the US. So yen crisis could create a global bond problem. So Washington's motive here is a little bit protect the bond market, also protect their government bond yields a bit. It's not really a charity instance, this, but as is often the case, the bond market is the ultimate arbiter here. It's just a case of the authorities have been forced to defend this, and I think the currency here is kind of like, in essence, it's the costume over the big actor. You're looking at costume as in the yen, but actually what's underneath it is a story about the bond market, and that's, I think, really important. So I think potentially the second move going on here might be via the US FEMA repo facility. That might get used for future operations, but by doing that, though, that might create a situation where bond yields might move a little bit, but they need to be careful of this. But it could possibly work in terms of Japan getting dollars, which would help this situation a little bit more. But the signal in doing that, I think might be bigger than the intervention itself. Just the lengths that the US is willing to go to support the yen, I think is quite a big deal there. And I think that this could possibly be, in some ways, the precedent that how much the US will go to avoid dumping treasuries. So I think the US is now quite aware of where their interest rates are on their government debt, and that they need to stop adding factors to help the sell-off on that. However, as we've previously spoken about, real yields are looking very attractive at the moment. So I think until, in some ways, there's already quite good incentive to hold government, developed market government debt. It's about how do we make this yen carry trade perhaps not quite so an element that helps fuel bubbles, etc., and deflate it in a in a calm way. Let's say that it's not dangerous in terms of how it's finally, as all trades eventually do, come to an end. The thing as well, though, that's a little bit worrying in the longer term, as I said, is that carry unwind. You've got to think where those sums are being borrowed go to. So it's dollar assets generally. It isn't just a case of government debt. So it's also an awful lot of where this has been borrowed has been going into US tech, emerging markets, etc. So if yen strengthens too quickly and this carry trade unravels too quickly, you get a really violent wind back of a lot of thematic trades. I think a preview of that we had was going back to August 2024, where exactly this happened. This orderly intervention reduces the risk of us having these violent pullbacks, but it's something to stay very aware of. So we don't have any dedicated active yen position. We did for some periods do some hedging with the yen. However, we currently felt that we tend to look more fundamentals rather than wider trades. So we undid our hedge even though the yen was selling off further, not because of where we thought direction was going, on a technical or basis, but just on the fundamentals. So we don't have a view at the moment actively. We're not playing FX on Japan, mostly due to the fact that, as I said, that we think it's dislocated from the fundamentals because of this carry trade element. And I think that is where we're coming to. Eventually the fundamentals will come back into play, but it's making sure, as I said, that this carry trade unwinds in a more in an ordered fashion. So as I said, this it's just for information only, and it's not advice, it's not a personal recommendation. And obviously you need to be careful in the markets, capital at risk. Past performance is no guide. I don't think I mentioned any past performance in this episode, which is a relief for a change. And obviously the views are, as we record right now, they very much may change by the time you read this. And obviously seek independent advice if you are unsure as to your investments. I'm Sam Howlett. This has been Capital in Context. Until next time, bye-bye.